Okay, so about the balance sheet, imagine you're in charge of managing a bank. So we have the bank, you're in charge of that bank. Your job is to do what? To ensure that your bank is financially stable and profitable, right? So there is a bank there that we want to manage it, okay? And we want to know, for managing this bank, what we have to do. And to do that, you need to understand how banking works and its core, and that's where the bank balance sheet comes into play. So we have the bank balance sheet. And what is a bank balance sheet? The bank balance sheet is like a snapshot of the bank, okay? So it's a list of the bank's assets and liabilities. Okay. So think of assets as things the bank owns, and liabilities as the promises the bank has made to others. So the assets, the bank owns, and the liabilities, the bank promises. So we have the balance sheet. The balance sheet is like what? The assets. The liabilities. Okay, and we have the equity or the capital. So think of bank's balance sheet as a financial snapshot, okay? As we said, something that will show you what we have on this side, okay, and what we have on this side. And it shows what a bank asset is and what it owns as the liabilities. So the magic rule is that assets, one side, is equal to liabilities plus what? The capital. Okay. So we have the sources of funds that the banks get money from borrowers and deposits, that is the liability, and use it to make money by investing in things like what? Loans, delivering the loans to the people, and also invested in securities. So that's also a kind of asset. So if we have a balance sheet here, the items that we might have would be something like the assets. That is what? The uses of funds. And we will have the liabilities. That is the source of fund. Okay. So on the asset side, what we might have, the reserves and cash item. We can have also securities. Okay. It could be the governmental bonds, for example, and other securities. And we will have the loans. The loans could be the commercial loans. It could be the industrial loans. It could be the loans for real estate, the loans that we deliver to consumers. We have some loans from the interbank relation of the banks to deliver to money to other banks, and other kinds of the loans that might be also possible. And from the asset side, we might have the other assets like the physical capital, for example. So we have the other assets also here. And finally, we will have a total for the asset side. Okay. From the liabilities side, we can have the checkable deposit. So non-transactional deposits. Like saving deposits and the small denomination time deposits that is less than, for example, 100,000. And we have the large denomination time deposits also, that they are all non-transactional deposits. And then we can have the borrowings and bank capital, and finally we have the total liabilities here. Okay, so the source of funds and also making profits, that the banks make money by charging higher interest on loans and investments that they pay out on deposits and borrowings. So they make the profit from this and making a good source of funds, and also making the profits are the responsibilities of the manager of the bank, and they have to make it a kind of balance between the asset side and the liabilities and capital, that it will be appeared in the balance sheet. So what might happen if we have a problem in the economy, like deterioration in, let's say, deterioration in bank's balance sheet? If we have a kind of instability in the interest rates and increase, for example, in interest rates because of the inflation, so we might have the increase in interest rate. And when we have these problems, a kind of higher risk in the market would be happier. The increase in interest rate would be another driver to have the stock market reflecting all of these changes, and we can expect that the stock markets decline, right? So we might have also the stock market decline. It could be because of the problems in the security, it could be a war, it could be some problems in the economy or in the financial system, and some financial crisis also might be the driver of all of this. So the stock market also will have some behavior, some response to whatever is happening, and from these problems we can expect that the stock market also decline. So all of this means what? Means that we have a kind of fear in the market, or the investors will stay to see that what might happen. So the increase in uncertainty or increase in risk could be the result of all of these problems. Okay? So from this we might have what? We might have the adverse selection, and moral hazard, problems. Okay, so all of these can make this problem And it means what? It means that from the problem that we have in the balance sheet, we can expect that we have a kind of fiscal balances, okay, that this might also increase the deterioration in bank balance sheets, okay? So these fiscal problems also might make another problem that it will be also the result from the adverse selection and moral hazard problems. That is a crisis that we might expect from what? The foreign exchange. Okay, so this would be the results from the fiscal balances and also the adverse selection and moral hazard problems. And then from this foreign exchange crisis that might happen, what might be expected? It might be expected to have the adverse selection and moral hazard worsen. So the problem would increase because the other sectors of the financial system will have some reflect, and we would have a worsened situation for the adverse selection and the moral hazards. So the people that they might have the lower, for example, credit score, they might like to have more loans from the banks or try to get more services from the insurance companies. And also after the contract, we might have some problems because of all of these problems in the economy, the behavior of the customers might be changed. So the adverse selection and the moral hazard might be increased because of all of these that is happening, and then we might have after that some effects on what? On the total economy. So the economy activity So the economic activities will decline, and when we have a problem in economy, we might have the systemic risk. So and this systemic risk might make some problems for the banks. So we might have the banking crisis, and this banking crisis might be like the domino effect transferred to the other sectors of the economy and the financial system or financial institutions. So again, this adverse selection and moral hazard will be worsened and worsened. So again, the adverse selection and moral hazard worsen, and again this will make the economy more under the stress. So we might have a kind of recession after a while, so that would be a big problem when we have the increase in the interest rate, the inflation, at the same time we have the economy activities decline, or a recession that is declining the economic activities for long term. So the balance sheet is very important, as we could see, to be monitored and to be analyzed by the experts in the banking system. For the insurance companies, that is the same. So if you want to look at the balance sheet and monitor it and see that what is the main effect of the economy on the banking activities and vice versa, we have to know about something that we call it the T account. So to make our analysis of the operation of a bank more concrete, we use this tool, the T account. That is a simple balance sheet, a simple way to have the balance sheet and to analyze it, to see that which items of the balance sheet are increasing, which items are decreasing, and what are the reasons. So let's see what will happen if I, as a person, as a customer of a bank, open a checking account, for example. So I want to open a checking account, okay, with 100 euros, for example. So checking account would be open with 100 bill, and I know have what? 100 euros checking account as what? As a deposit. Okay? So I have a deposit at the bank, which shows up as a 100 euros liability on the bank's balance sheet, right? So if we have the bank's balance sheet, what we might expect in the asset side, here we will have the liability side. So this is like a T, okay? And we have 100 euros increase in vault cash. So vault cash here would be increased by 100. And the T account looks like this. And then vault cash is also part of the bank's reserves, right? But before that, on the liability side, we will have the checkable deposits, because the money that I put there for the bank would be a kind of liability, and that is also with 100. So this 100 with this 100, we have the balance in the balance sheet, and the vault cash that we have here as the asset for the bank, that the bank is able to save it as the money or invest it in some securities, for example. So it is a part of the bank reserves. So we will have what? We will have on the asset side, it could be like this, that we have the O's again, okay, as the A for the asset and L for liabilities. And then here we will have the reserves also. Okay, so this is 100 reserves here, and here we can say that it is the checkable deposits as that 100, right? So what I might do as a customer, okay? Imagine that this customer wants to open an account in a bank. Okay, so the banks are responsible for the money that the people put there as the deposit. So that deposit for the bank would be the liability, but at the same time, that liability for the bank is what? Is a kind of asset that the bank can use it to take it for as the cash. It can also put it as the what? Kind of security in the market and invest it. Or if there is a kind of need, immediate need of the liquidity problem, for example, then the bank can use it immediately to cover whatever is needed based on the balance sheet and the items that we have there. So now imagine I had opened my account with 100 euros, okay, in this bank, written on an account at another bank, okay? So the second national bank, let's say, the initial effect of the T account, or the first effect that we might see in the balance sheet of the bank, again, would be the cash items. In process of collection, okay? So this is a check written on an account at another bank, okay? And this would be what we can see in the balance sheet. At the liability side, we can have the same, the checkable deposits with again 100, okay? So there is another bank here. And now we have two banks, and this is what's really expected to be here. But now the first national bank owned 100 euros by the second national bank. So we have to show it into two parts, the asset side and the liability side for bank A. Also, we will have the asset side and liability side for bank B, okay? So for bank A, as we said here, we have the reserves. currency unit. And the checkable deposits as 100. Again, for bank B, we have the reserves 100 and checkable deposits 100. Okay? So, to sum up, imagine you write a check from bank A and transfer it to bank B and bank B gains reserves like refueling, okay? So whatever is in the bank A would be a reserve in the asset side of the bank B, and bank A loses what? The reserves, like burning the fuel, okay? So the fuel that was here was transferred here, and it burned the fuel, it gained the fuel, and when a bank gets more deposits, reserves do what? The deposits will increase. It means that the reserves also increase. Okay? And when it loses the deposit, the reserves will do what? Decrease. Now we understood that how banks gain and lose the reserves and how they transfer money and what would happen in the balance sheet, and how we can show all of these transactions by the T account from the two sides, the asset side and the liability side, and how we can show all these transactions that might happen.